Disclaimer.
Hey, it's Economics Exposed. Right now, as you're watching this, a massive financial decoupling is happening that 99% of North Americans are completely blind to. While you were sleeping, the Shanghai Gold Exchange just posted a silver price of $104.80, but here in the West, the COMEX is still trying to tell you it's worth $86. That is a 21.3% price gap. It's the largest arbitrage window in the history of precious metals. And it means the paper price you see on your banking apps is officially a lie. Tonight, at exactly 3 a.m. Eastern, the London Open is going to face a moment of truth. They are staring down a 12.7 million ounce physical withdrawal that happened in just the last 7 days. That is not paper trading. That is the equivalent of 2 Boeing 747s made of solid silver physically leaving the vaults, because the East is calling the West his bluff. If you think the flash crash we saw last week to $78 was a sign of weakness, you fell for the trap. That was the smart money clearing the board before the physical reality of Shanghai breaks the London fix forever. We are tracking 284 million ounces of short positions held by 3 major banks that are currently trapped with no physical metal to deliver. The financial establishment wants us to believe this is temporary market noise, a quirk of Asian demand that will normalize once things calm down. But this spread has been widening systematically for the past 14 months, not shrinking. Every time London tries to narrow the gap by raising their quoted price, Shanghai pulls further ahead within days. We're watching a permanent shift in the global power structure of precious metals pricing, and the implications touch every retirement account, every mining stock, and every industrial company depending on this metal. The Shanghai Gold Exchange, known as SGE to those of us who track these flows, has quietly become the largest physical precious metals marketplace on Earth. While we've been checking COMEX prices and trusting London's morning fix to tell us what silver is worth, the real price discovery has been migrating east for years. The difference is that now the gap has grown so wide that it can't be hidden anymore, and the mathematical reconciliation is going to happen whether London's ready or not. Here's the mechanism most investors never see. For over 100 years, London and New York have operated as the gatekeepers of precious metals, pricing through a system of paper derivatives, futures contracts, and unallocated accounts. When you buy silver through most brokerages, you're not actually buying metal you can hold in your hand. You're buying a promise that someone will deliver that metal to you someday if you really want it. The system works perfectly fine, as long as most people never actually ask for delivery, and as long as everyone agrees that the paper price and the physical price are the same thing. The brilliance of this system, from the bank's perspective, has always been leverage. They could sell 100 ounces of paper silver backed by only 10 ounces of physical metal sitting in a vault somewhere, knowing that, statistically, only a tiny fraction of contract holders would ever demand actual delivery. It's the same principle banks use with checking accounts. They don't keep everyone as cash in the vault because they know everyone won't withdraw at once. This fractional reserve approach to precious metals has generated enormous profits for decades because paper contracts are cheap to create, while physical silver has mining costs, storage costs, and transportation costs. But that mathematical magic only works in one direction. When demand for physical delivery starts exceeding available supply, the entire structure inverts. Suddenly, those 100 paper ounces need to be backed by 100 real ounces, and the 10 ounces sitting in the vault aren't nearly enough. The institutions that sold those 90 phantom ounces now face a choice: buy physical metal at whatever price the market demands, or default on their delivery obligations. Neither option is pleasant when you're facing the scale of short positions we're seeing right now. Shanghai broke that gentleman's agreement by building a market that only deals in physical metal, where every transaction requires actual bars to change hands. No promises, no paper, no leverage, just warehouses full of silver that move from seller to buyer with complete transparency. The SGE didn't set out to destroy London's pricing power. They simply built a better system for people who wanted real metal instead of financial abstractions. But the side effect of that honest marketplace has been devastating to the Western pricing mechanism that relied on most participants never calling the bluff. Think about what this means in practical terms. When a Chinese manufacturer needs silver for solar panels or electronics, they can't buy a futures contract and hope someone delivers months later. They need physical metal on a specific timeline for production schedules that can't slip. The SGE serves that real economic need by guaranteeing that every transaction settles in actual metal within days. This isn't speculation or financial engineering. It's the physical economy demanding physical commodities. And that fundamental honesty in pricing has exposed just how disconnected Western paper markets have become from actual supply and demand. The ripple effects extend beyond just pricing. Major refineries have started prioritizing Shanghai contracts over London contracts because payment and delivery are certain rather than theoretical. Mining companies are increasingly selling directly into Asian markets, where premiums reflect actual scarcity rather than suppressed paper prices. Insurance companies and logistics firms are adjusting their entire operations around the reality that physical silver is migrating east and may not come back west at prices our markets consider normal. The massive price gap we're seeing represents the exact cost of that bluff getting called. Think of it as the market's way of saying that one price is what you can quote on paper, while another is what you actually have to pay to take possession of physical silver in quantity. That gap is the premium for reality over fiction, and it's widening because fewer and fewer people are willing to accept the fiction anymore. What makes this moment particularly critical is the timing of several converging forces that have never aligned quite like this before. The overnight accumulation from Asian trading hours has to be reconciled with Western positions, and when the spread reaches these extreme levels, the smoothing mechanisms that normally keep prices stable across time zones stop working, because the mathematical cost of bridging the gap exceeds what most institutions can afford to pay. Have you noticed how mainstream financial media has been unusually quiet about silver lately, even as gold continues making headlines? That silence is strategic. As long as retail investors in North America aren't paying attention to the Shanghai premium, institutions have time to quietly reposition their exposure before the general public figures out what's happening. But once the spread breaks into public consciousness, and people start demanding physical delivery at Western paper prices, the entire structure of how we've traded precious metals for generations will need to be rebuilt almost overnight. The arbitrage opportunity here would normally attract billions in capital trying to buy in London and sell in Shanghai, pocketing that massive difference. So why hasn't that trade closed the gap? Because it requires something that paper markets can't easily provide: actual physical silver in the right place at the right time. You can't arbitrage what doesn't exist in sufficient quantity to move, and London's vaults are discovering that their inventories aren't nearly as deep as their paper promises suggest they should be. Even when physical silver is available in London, the logistics of moving it to Shanghai take weeks. You need proper refining to meet SGE standards, insurance for international transport, customs clearance, and verified storage in approved facilities. By the time you complete that process, the spread could have widened further, or worse. You might arrive in Shanghai only to discover that the premium has shifted to a different grade or form of silver entirely. The arbitrage that looks obvious on a screen becomes impossibly complex when dealing with tons of physical metal crossing oceans. More importantly, the institutions that could theoretically execute this arbitrage are the same ones holding massive short positions that would benefit from keeping London prices suppressed. If JP Morgan or HSBC started buying enormous quantities of physical silver in London to ship east, they'd drive London prices up dramatically, triggering margin calls on their own short books. They're trapped in a position where the profit from arbitrage would be dwarfed by the losses from their existing derivatives exposure. This is onto free market finding equilibrium. It's a checkmate position where every move makes the situation worse for the players who created it. This brings us to the uncomfortable truth that most brokerages won't tell you. The silver price we check every day on our investment apps isn't really the price of silver anymore. It's the price of a derivative contract that used to correlate perfectly with physical metal, but has now diverged into its own separate reality. We're living through the moment when that correlation breaks down permanently, and the question for American investors isn't whether this reset will happen, but whether we'll be positioned correctly when it does. The mechanism is visible, the pressure is building, and tonight's London Open will test whether Western banks can continue quoting prices that physical reality no longer supports. What happens next isn't a matter of speculation or theory. It's pure mathematics, meeting physical scarcity, and we're all about to learn which one wins when they collide. Now let me show you exactly why this isn't just theory or speculation, but a mathematical certainty backed by hard data that the institutions can't hide anymore. The numbers coming out of the COMEX right now are so extreme that even seasoned precious metals traders are doing double takes at their terminals. According to this month's COMEX warehouse reports, registered silver stocks, that's the metal actually available for delivery against futures contracts, have collapsed to just 31 million ounces. Think about that number for a moment. 31 million ounces sounds like a lot until you compare it to what's been promised. The March contract open interest currently represents 500 million ounces of paper obligations. That's a 16-to-1 leverage ratio where for every ounce of real silver sitting in COMEX vaults, the exchange has sold promises to deliver 16 ounces to various contract holders. This isn't a normal market condition. This is a game of musical chairs where there are 16 people standing and only one chair left. When the music stops and everyone tries to sit down simultaneously, 15 people are going to be left standing with worthless paper, while one person walks away with the actual metal. The question American investors need to ask themselves is which group they're in right now. Let me put this in perspective with a scenario you can relate to. Imagine you're at a concert venue that sold 500 tickets, but fire code only allows 31 people in the building. The promoter keeps selling tickets because, historically, most people who buy concert tickets don't actually show up, so it's been profitable to oversell. But what happens when this time is different? What happens when 400 people actually show up demanding entry? The promoter can either refund tickets at face value and go bankrupt, or let the crowd rush the doors and hope the building doesn't collapse. That's exactly where the COMEX stands right now with silver contracts. The evidence of panic became undeniable on January 30th, a day that insiders are now calling Black Friday. At market open, silver was trading at $114 per ounce. Within 6 hours of continuous selling pressure, the price had crashed 31% down to $78. 31% in a single trading session for a precious metal that typically moves 1 or 2% per day. That's not normal market volatility, that's a controlled demolition. Here's what you need to understand about that crash. It wasn't triggered by negative economic news or a sudden discovery of massive new silver deposits. The timing was surgical, the volume was coordinated, and the aftermath revealed exactly who was behind it. According to data from the Commodity Futures Trading Commission, 3 major banks that we track closely hold a combined short position of 284 million ounces. Those same institutions were the primary sellers during that 6-hour window, dumping futures contracts by the thousands to drive the price down as violently and quickly as possible. Why would they do this? Because they needed to shake out every weak hand, every leveraged retail trader, every momentum fund that had stop-loss orders sitting below $90. They needed those positions to capitulate and sell at a loss so the smart money could cover some of their shorts at basement prices before the real squeeze begins. Think of it as the last desperate clearance sale before the store gets permanently closed by forces beyond their control. But here's where the plan backfired in spectacular fashion. The crash to $78 lasted less than 48 hours before a wave of physical buying emerged that our markets had never seen before. This wasn't retail investors panic selling into the crash. This was sovereign wealth funds, central banks in emerging markets, and major industrial consumers recognizing the opportunity of a lifetime. When silver briefly touched $78, they didn't see weakness. They saw a fire sale on a strategic resource that the Western banking system just admitted they were desperate to suppress. The price action that followed has a name in precious metal circles, the debasement trade. Within 5 trading days, silver had rocketed back from $78 to $90, and it's still climbing as physical demand overwhelms the paper selling pressure. This wasn't a technical bounce or a short squeeze in the traditional sense. This was the global market collectively deciding that if Western institutions are willing to crash prices 31% just to cover shorts, then the real value must be far higher than anyone previously estimated. According to the World Gold Council's latest precious metals report, Asian central banks increased their combined silver reserves by 11% in the fourth quarter of 2025 alone. That is not jewelry demand or industrial usage. That's sovereign nations stacking physical metal as a monetary reserve asset. When central banks start treating silver like a currency rather than just an industrial commodity, it signals a fundamental shift in how the global financial system views precious metals during currency instability. The domestic situation in our own country adds another layer of urgency that most Americans aren't aware of yet. The U.S. Mint announced on February 3rd that the highly anticipated 250th anniversary Silver Eagle coin release has been delayed from its original February 10th launch to February 26th. On the surface, they're blaming production scheduling and quality control. But anyone paying attention knows what a mint delay really means. They can't source enough physical silver blanks from refineries to meet expected demand. Think about the implications here. The United States Mint, backed by the full faith and credit of the federal government, has effectively admitted they can't get their hands on enough physical silver to fulfill orders for commemorative coins. This isn't some private dealer running out of inventory. This is an official government institution, signaling national scarcity of a metal that America uses in everything from solar panels to military electronics to medical equipment. If the Mint can't secure supply, what does that tell you about industrial manufacturers who need consistent deliveries for production lines that can't just shut down and wait? The retail market has responded predictably. According to precious metals dealer networks across North America, premiums on physical silver eagles have exploded to 40% over spot price. That means if paper silver is trading at $86 on the COMEX, retail buyers are actually paying $120 per coin just to take physical possession. That 40% premium is not profit margin, it's the market. It's a way of saying that paper prices have become so disconnected from physical reality that dealers need to charge a massive markup just to source coins that may or may not be available when customers actually want delivery. Coffee premiums might spike 5% during a bad harvest, Oil premiums might hit 10% during refinery shutdowns, but 40% premiums are what you see during actual supply emergencies, where the underlying commodity simply isn't available at quoted prices. That's not a market functioning normally. That's a market breaking down in real time. The pattern becomes even clearer when you examine the flow of physical metal through refineries and logistics networks. Major Swiss refineries, which process much of the world's silver, have started prioritizing Asian contracts over Western contracts because the Shanghai premium guarantees immediate payment and pickup. According to industry reports, refinery schedules for Western deliveries are now showing lead times of 8 to 12 weeks, while Shanghai contracts are being fulfilled within 10 days. The metal is physically migrating toward the market that values it honestly rather than suppressing it through paper manipulation. Have you noticed how quiet mainstream financial media has been about these developments? CNBC isn't running hourly updates on the COMEX inventory crisis. Bloomberg isn't interviewing silver analysts about the 16-to-1 leverage ratio. The Wall Street Journal hasn't published investigative pieces on why the U.S. Mint can't secure a supply of a metal that America supposedly has abundant access to. That silence is calculated. As long as retail investors aren't connecting these dots, institutions have more time to unwind positions before the stampede begins. But the insider actions tell a different story than the public silence. According to SEC filings, executives at 3 major mining companies increased their personal silver holdings by an average of 23% in the fourth quarter. These aren't random investors gambling on price movements. These are people who run the companies that actually dig silver out of the ground, and they're buying the metal themselves, rather than just owning shares of their own companies. And when mining executives choose physical silver over their own stock options, they're sending a signal about where they think real value lies. The technical positioning adds another dimension to this evidence. According to the latest Bank for International Settlements derivatives report, the notional value of silver derivatives held by commercial banks has reached an all-time high of $42 billion. But here's the critical detail. The vast majority of those derivatives are short positions betting that silver prices will fall or remain suppressed. Those positions were profitable for years when paper markets could dictate prices independent of physical supply. But now that Shanghai has created a genuine physical price discovery mechanism, every one of those short derivatives represents a potential liability rather than an asset. Let me walk you through the math of what happens when this unwinds. If silver moves from its current paper price of $86 to match the Shanghai physical price of $104, that's an $18 move. On 284 million ounces of short positions, that $18 move represents $5 billion in losses for the 3 major banks holding those positions. And that's just the move to current Shanghai prices. It doesn't account for what happens when Shanghai prices themselves spike higher as Western buyers finally realize they need to enter that market to get real metal. The evidence isn't just in the numbers and the data. It is in the behavior of participants who have inside information about what's really happening. When refineries change delivery priorities, when sovereign wealth funds accumulate during crashes, when the U.S. Mint delays flagship products, when retail premiums hit 40%, and when mining executives personally stack metal, those actions speak louder than any price chart or analyst report. These are people and institutions positioning for an outcome they see coming, but aren't announcing publicly until they're ready. What makes this moment unique in precious metals history is that all of these proof points are converging simultaneously, rather than occurring in isolation over years. We're not looking at one anomaly that could be explained away. We're looking at a pattern of evidence across inventory data, price action, mint operations, retail premiums, refinery logistics, insider positioning, and derivatives exposure that all point toward the same conclusion. The Western paper silver market has stretched its leverage to the breaking point. Physical supply is migrating toward markets that price it honestly, and the mathematical reconciliation is no longer a question of if, but when and how violently it occurs. The 31 million ounces sitting in COMEX registered vaults are not going to magically multiply into 500 million ounces. The Shanghai premium isn't going to disappear just because Western banks wish it would. The U.S. Mint isn't going to suddenly find unlimited silver supply by late February. And retail buyers paying 40% premiums aren't going to accept paper promises much longer when they can see with their own eyes that physical metal commands completely different pricing. Every one of these facts is independently verifiable and collectively damning for anyone still believing that the paper price represents reality. Now, let's talk about where this goes from here, because the math isn't just compelling, it's inevitable. When you combine supply constraints with exploding industrial demand from sectors that can't function without silver, you get a price equation that solves itself regardless of what paper markets want to believe. The Silver Institute's latest demand forecast projects that industrial consumption will reach 1.2 billion ounces in 2026. While global mining production is expected to deliver just 840 million ounces. That's a structural deficit of 360 million ounces that has to be filled from somewhere. In previous years, that gap could be bridged by drawing down inventory stockpiles or recycling scrap metal. But here's the problem. According to the World Silver Survey, above-ground inventories have already been depleted by 17% over the past 3 years, and scrap recovery rates have plateaued because most of the easily recyclable silver has already been reclaimed. Think about what a 360 million ounce annual deficit means in practical terms. That's roughly 12 times the amount of registered silver sitting in COMEX vaults right now. Every single month, the global economy needs 30 million ounces more silver than miners can produce. Where does that metal come from when stockpiles are already drawn down and paper markets can't conjure physical ounces out of thin air? The demand side of this equation is being driven by two massive technological shifts that most investors still don't fully appreciate. First, the artificial intelligence hardware boom requires silver at a scale we've never seen before. Every data center expansion, every AI chip fabrication facility, every high-performance computing cluster uses silver in quantities that make traditional electronics look trivial. According to semiconductor industry reports, a single advanced AI training chip contains approximately 0.3 grams of silver in connections and thermal management systems. When companies like Microsoft, Google, and Amazon are ordering these chips by the millions to build out AI infrastructure, you're looking at industrial demand that didn't even exist 5 years ago. But the AI demand is actually the smaller story compared to what's happening in the energy sector. Small modular reactors, known as SMRs in the nuclear industry, are being deployed at an unprecedented pace as countries race to build carbon-free baseload power. The United States alone has approved 12 new SMR projects for construction starts in 2026, and each reactor requires approximately 75,000 ounces of silver for electrical systems, control mechanisms, and safety features. That's 900,000 ounces just from American nuclear projects this year, and globally, the SMR pipeline includes over 100 reactors in various stages of planning and construction. Let me walk you through a scenario that makes this real. Imagine you're a procurement manager at a semiconductor fabrication plant in Arizona. Your production line requires steady deliveries of silver wire for chip bonding, and any disruption in supply means shutting down a facility that costs millions of dollars per day to operate. You used to order silver months in advance at stable prices, confident that suppliers would deliver on schedule. But now your suppliers are telling you lead times have stretched to 10 weeks, prices are quoted as subject to availability, and preferential delivery goes to customers willing to pay Shanghai premiums rather than COMEX quotes. Do you shut down your production line over a pricing dispute, or do you pay whatever it takes to keep the metal flowing? That's the calculation being made right now across hundreds of industrial facilities, and every single one of them is choosing to pay higher prices rather than risk production shutdowns. This isn't speculative demand from investors trying to make money on price appreciation. This is structural demand from companies that have no choice but to secure supply at any cost, because the alternative is catastrophic business disruption. The mining supply side offers no relief to this demand pressure. According to data from the World Bureau of Metal Statistics, global silver mine production has been essentially flat since 2015, despite prices that should have incentivized massive expansion. The problem is that 70% of silver comes as a byproduct of copper, lead, and zinc mining. You can't just decide to mine more silver. You have to mine more of the primary metals that happen to contain silver as a secondary product. When copper prices are weak or zinc demand is soft, silver production stays constrained regardless of what silver itself is worth. New mine development takes 7 to 10 years from discovery to production, meaning any supply response to today's prices won't hit the market until the early 2030s at the earliest. There's no quick fix, no emergency capacity that can be brought online, no strategic reserve that governments can tap to flood the market. The supply is what it is, and what it is happens to be 360 million ounces short of what the world needs this year alone. Now here's where the math gets really interesting for North American investors who are trying to figure out what price this resolves at. The current Shanghai premium of 21.3% over COMEX prices gives us a baseline for where physical silver actually trades when paper manipulation is not suppressing the quote. If we apply that premium structure to realistic supply-demand fundamentals, we're looking at a target of $125 per ounce by the end of Q1 2026. That's not a wild speculation or a moonshot prediction based on hope. That's what happens when you take the Shanghai physical price of $104 factor in the continuing industrial demand surge account for the COMEX inventory crisis, forcing delivery premiums higher, and recognize that retail buyers paying 40% over spot are establishing a new floor for what physical metal actually costs in quantity. $125 by late March isn't even aggressive. It is what basic math dictates when paper prices can no longer suppress physical reality. But here's the part that should really grab your attention. That $125 target assumes a relatively orderly transition where London and COMEX gradually raise quotes to match physical markets. The much more likely scenario, based on historical precedents and current positioning, is that we don't see a smooth climb at all. We see a limit-up vertical move that happens so fast, most investors won't have time to react. Think back to the flash crash on January 30th when silver dropped 31% in 6 hours. That violent move down to $78 was not random. It was the smart money's last desperate attempt to shake out retail positions and create one final exit opportunity for their short positions before the trap slammed shut. That 81.50 low point, which briefly touched 78 before bouncing, represents the absolute floor where institutions could still cover meaningful portions of their 284 million ounce short exposure. If you sold silver anywhere near that low, you didn't make a smart risk management decision. You fell for a trap that was specifically designed to transfer your physical metal to entities that understand what's coming next. Those same institutions that engineered the crash are now positioned on the opposite side, knowing that when Shanghai's premium finally forces London to bridge the gap, the price won't rise gradually over weeks or months. It will gap up in a single session, potentially jumping $20 to $40 overnight as years of paper manipulation unwind in hours. Have you studied what happened during the Hunt brothers silver squeeze in 1980? The price went from $11 in September 1979 to $50 by January 1980, a 450% move in 4 months. But here's what most people forget about that episode. The final move from $35 to $50 happened in just 8 trading days. Once the squeeze mechanics kicked in and short positions started getting forced to cover, the vertical acceleration overwhelmed every attempt at orderly trading. Circuit breakers didn't exist back then, but if they had, silver would have been hitting limit-up halts every single day during that final sprint. The current setup makes the Hunt brothers' squeeze look like a warm-up exercise. Back in 1980, the Hunt brothers were trying to corner the market through concentrated buying, while facing the full opposition of the COMEX, the federal government, and the banking establishment. Today, we're watching a scenario where the COMEX itself is on the wrong side of the trade, where government mints can't secure supply, and where the global industrial economy is competing with financial speculators for a metal in genuine shortage. The Hunts had to fight the establishment. This time, the establishment is trapped by their own leverage. According to historical analysis from precious metals, research firms every major silver squeeze in the past century has shared certain characteristics: unsustainably high short positions, declining inventories, industrial demand competing with investment demand, and a catalyst that forces price discovery back to physical reality. The 1980 squeeze had those elements. The 2011 run to $48 had some of them. But right now, in early 2026, we have all of them simultaneously at levels we've never seen before, plus the added dimension of a Shanghai market that can't be manipulated through paper derivatives. Let me paint you a picture of what the next 6 weeks could look like. Tonight's London Open handles the 12.7 million ounce withdrawal we discussed earlier, but only by rating eligible stocks and converting them to registered status, a move that works once but can't be repeated when the next wave of delivery demands hits next week. By February 20th, the U.S. Mint releases the delayed 250th anniversary Silver Eagles into a market where retail premiums have climbed to 50% over spot because the artificial scarcity from the delay has intensified demand. Industrial buyers who have been holding off on forward purchases realize that they can't wait any longer and start bidding aggressively for any available supply. Somewhere between February 23rd and 27th, a major refinery or a sovereign buyer refuses to accept COMEX pricing for a large delivery and demands Shanghai equivalent prices. That single transaction becomes public through industry channels, and suddenly every industrial buyer realizes they've been subsidizing financial games by accepting suppressed quotes. The scramble for physical metal hits critical mass, and London has no choice but to reprice silver up $20 to $30 in a single session just to keep their market functioning. That's when the real chaos begins, because every short position holder who thought they had time to cover gradually discovers they are out of time completely. Margin calls cascade through the system. Funds that were short silver as part of balanced commodity strategies get forced to buy at any price. The paper markets that spent decades building leverage discover that deleveraging does not happen slowly when everyone tries to exit simultaneously. And retail investors who trusted their brokers to deliver physical metal at paper prices find out that subject to availability means not available at these prices anymore. What can you do with this information? First, understand that if you don't already own physical silver that you can hold in your hand, buying paper contracts or ETFs right now is like showing up to that oversold concert with a ticket printed on tissue paper. You might have paid for it, but that doesn't mean you're getting in when everyone rushes the doors. Physical metal, stored securely where you control it, is the only position that survives the transition from paper pricing to physical reality. Second, recognize that the next 4 weeks represent the final window where physical silver might still be available near current premiums. Once the US Mint release hits, once London faces another major delivery demand, once industrial buyers stop accepting COMEX quotes, that window slams shut and doesn't reopen at prices anywhere near what we're seeing today. The spread between paper and physical could easily hit 50% or more during the transition period, meaning that $86 COMEX quotes might require $130 actual payments to secure real metal. Third, and this is critical, don't try to time the exact bottom or wait for one more dip. The institutions that engineered the $78 flash crash did it specifically to create that temptation. They want you waiting on the sidelines for another buying opportunity while they accumulate everything available at current prices. That 81.50 level was the trap, and if you're still waiting for it to come back, you're going to miss the entire move. The mathematics of this situation are brutal and unavoidable. 360 million ounces of annual deficit cannot be solved by 31 million ounces of COMEX inventory. Industrial demand from AI and nuclear energy cannot be wished away because it's inconvenient for short sellers. Shanghai's physical pricing cannot be suppressed by London's paper contracts when the physical metal trades openly at 21% premiums, and 284 million ounces of short positions cannot be covered without driving prices dramatically higher when only limited physical supply exists to buy. When this resolves, and it will resolve in the next 6 weeks, whether institutions are ready or not, we're not going to see a gentle climb that gives everyone time to adjust. We're going to see the kind of vertical move that gets studied in financial history courses for decades as an example of what happens when leverage meets scarcity and mathematics wins. The $125 target by end of Q1 is just the beginning of a revaluation that could take silver to levels that seem absurd right now, but will seem inevitable once the squeeze mechanics fully engage. The setup is complete. The evidence is overwhelming. The math is inescapable. And the timeline is measured in weeks, not months or years. Every day that passes with Shanghai trading at massive premiums over London is another day closer to the moment when that gap closes violently upward rather than peacefully downward. Position accordingly, because this train is leaving the station whether you're on board or not.